Let's take a look at how we are finishing up the day on Wall Street. Not as good as it was in terms of the bullish momentum, but good enough to get a new record closing high for the Dow Jones Industrial Average. As long as it finished higher, we'd get a new record, and it did. Up 56 points, 0.2%. S&P couldn't quite get there, though. Earlier in the session, when things were looking a little stronger, it was tracking toward a record close. The level to watch would have been 29.30, as you can see, off of those highs. NASDAQ closing higher by 1/3%, so technology bouncing back today. The banks also had a very strong day, best performing sector in the S&P off those higher treasury yields. And the Russell 2000 also got a boost. Not enough to make up for the declines of this week, but still up almost 1%. Shares of General Motors finished the day higher, while shares of Honda sank on news that the Japanese automaker will be investing billions with GM to help develop autonomous cars. Whether this will spark more partnerships and deals, we'll have that discussion coming up. Let's talk about this record-setting market. Joining the panel, we've got CNBC senior markets commentator Mike Santoli, and Jason Trennert joins us, chairman of Strategas Research Partners. Welcome, Jason. Biggest winner on the Dow today was Caterpillar. B&G was the biggest loser. Over in the S&P, SVB Financial, the winner, and International Paper, the biggest loser. Dow closing at a record high, finishing higher by, looks like 56 points. This is, guys, the 15th record close for the Dow this year. There have been more than 100 record closes for the S&P since the election, something President Trump was tweeting about recently, but all we needed was a higher close for the Dow, and we got it. Why did the other averages seem, and the Dow seem to lose some steam?
Further progress. I mean, the way the market is set up right now, it's as if the bulls and bears always play a close game. Now, the bulls have been winning most days and obviously making the most progress, but there's always an undertone of something that's a little bit taking a back seat or moving to the sidelines. I think that's basically the story again today. 60% of all volume on the New York Stock Exchange was up, but that means 40% is down. That's the kind of environment we're in. So I think the key themes today, banks and small caps bounced where they had to, because had they not responded to these being very oversold, I think a lot of people would have said, what's really the secret story there of what's going on that's negative? That didn't happen. So I think it's a bit more of the same. I don't know if these thresholds of Treasury yields got people a little bit spooked. It seemed as if when the 10-year got above 315 and the 30-year got above 330, that's when stocks backed off.
Jason, and whether people got a little bit spooked by the end of the day, the reason we saw rates move up was because some very strong economic data. I mean, how positive is that data, and how optimistic can we be that it can continue?
Well, I think you can be pretty optimistic that the economic data can continue to be quite good. I think the difference now, though, I'd say versus after the financial crisis, financial markets greatly outperformed the economy. I think you're in a situation now where the economy is going to start outperforming the financial markets to the extent to which it's going to suck out more liquidity. And there are a lot of, we could discuss the policy mix that allowed that, but President Trump's policy mix is extremely stimulative for nominal GDP growth. And that would suggest that you're going to get higher rates. That would also suggest that earnings multiples should come down. If there's good news, it's good for active managers, it's good for dispersion of returns, but it's not going to be quite as easy to get the returns that you got in the past, in my opinion.
Well, we are going into earnings season right now in the third quarter, and I mean, if you look at the FactSet numbers, Mike, they're pretty strong. And for all this talk of peak earnings, we're still looking at 20% plus earnings growth. The question is, are we going to start to see warnings on tariffs, warnings on the strong dollar? We already got that a bit from PepsiCo and other sort of conservative outlooks, which wouldn't justify these stock prices.
And there have been more warnings, companies giving negative guidance leading up to this reporting period than there have been in several quarters. But no, I think that you could plug in great earnings growth every quarter this year, and the market says that's great. That's our base case. That's what's supporting stocks right here. That's why we're up 10% year to date. But how much further can I extrapolate that out? And what are the offsets in the form perhaps of higher yields down the road? So I don't know that it's going to be. Earnings season has not been when this market has made the most progress. It's before and after, typically, even though earnings have been great.